Good morning, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, July 15th, 2024. So, economic activity last week that was released completely dominated by inflation. We actually had two metrics that came out last week, four technically, two primary, and they were actually split, but the markets favored the upside, which was last Thursday we had the CPI report. Expectations for headline rate for CPI was it would be up 0.1%. Actually came in negative 0.1% for June. So very favorable. Core inflation rate that was expected to come in at 0.2% month over month came in at 0.1%. So that means trailing 12-month CPI inflation is running at 3.0% and core inflation at 3.3%. So as we'll see, markets reacted very favorably to that news last week. Then the very next day, we got the PPI, Producer Price Index numbers, also for June, and they were much less favorable. They're actually negative, yet the market pretty much shrugged it off. So PPI headline number was expected to come in June, month over month, positive 0.1. It came in at a positive 0.2, and then core PPI was expected to come in at a positive 0.2. It came in at a positive 0.4. But again, prior day CPI numbers came in, investors loved it. So net, the week turned out just fine. We'll see how the markets reacted, but it's favorable. Last thing, in terms of economic data last week, we had the Michigan Consumer Sentiment number, preliminary number for July, and that number was actually worse than expected. It was expected to come in at 68.5. It came in at 66. So with all that news, we take a look at what the Atlanta Federal Reserve believes the U.S. economy did in the second quarter. Very surprised. I'm often surprised by their estimates, but they took up expectations for second quarter. So the week before, they were at 1.5% growth for second quarter, which would be good. I think a really good number. They actually bumped that up to a positive 2.0%. In terms of inflation expectations last week, the 10-year break-even actually was down a few basis points, actually down 4 basis points at 2.24, so that's our best estimate of inflation expectations for the next 10 years. In terms of the Fed funds future and expectations, so we have a Fed meeting at the end of this month, July 31st. Almost no chance the Fed's going to decrease at that point or make any change in terms of rates. 93% probability built in that there will be no change. However, after that, particularly September, things are expected to change significantly. There's an 88% chance built into the Fed funds future market that we'll get one rate cut in September, and actually a 6.3% probability that we'll get two rate cuts. But then by the end of the year, these expectations have been rising. Now, remember, coming into this year, investors expected 6 rate cuts, and we're disappointed as we went through the first quarter. Very clearly, economic growth was too strong. You really couldn't make the argument for rate cuts. So investors backed off. Now they're actually starting to ramp back up expectations. So by the end of the year, the expectation now is over a 50% probability we'll get 3 rate cuts, which is up significantly from a month ago. So the expectation for 3 rate cuts by the end of the year, 54.6% probability of that happening. That is up. It's almost double. That is double the week before, which is at 27.5%. So investors getting excited about rate cuts that they expect coming by the end of this year, starting in September, and that drove markets. Again, we'll see the returns in just a moment. Last thing about last week that was very favorable for the market, S&P earnings companies that reported earnings better than expected. Their stocks were mixed, but the EPS numbers came in better than expected. Now, this is early in the cycle, so it's mostly financials that reported. But nonetheless, the expectations going into last week that we would see 11.2% EPS growth for the S&P 500 for second quarter earnings. FactSet has bumped up their estimate as of Friday based on good earnings releases so far. They expect it to be over 12% for the second quarter, which would be the best earnings growth that we've had since the first quarter of 2022. So, with all that great news last week, how did the markets respond? Good. U.S. stocks up, international stocks up. U.S. fixed income up. One thing that is notable, though, last week is the leadership in the U.S. So the S&P 500 up roughly 0.89% last week. However, what really drove the markets in the U.S. is not what has led the market for year-to-date or really for 2023, which has been large cap growth and specifically large cap tech. The leadership is actually much spread out, much better than we've seen most recently. So the equally weighted S&P 500 was actually up 2.9%. And the biggest news last week in terms of stocks, U.S. small cap was on fire. Best week they've had in well over 2 years. So the Russell 2000 last week was up 6%. Again, the S&P up 0.9%. So great to see a change of leadership, at least for a week, and particularly led by small caps. International markets did well, better than the S&P 500. Developed markets ex-US up 2.33%, and emerging markets up 1.69%. In terms of fixed income, another rally in fixed income. 2-year yields down 15 basis points. The 10-year yield down 10 basis points, which led to the Bloomberg U.S. Aggregate Bond Index being up 82 basis points. Coming into last week, it was exactly flat year-to-date, so that takes a year-to-date up to positive 0.82%. So let's take a look at economic activity hitting this week. Much less than last week, probably much less impactful. The big day is tomorrow, which is Tuesday, and it's going to be retail sales that will drive. That's really the biggest metric coming out this week. So you have retail sales for June that are coming out, retail sales and retail sales ex auto. So the consensus expectation retail sales month over month for June is going to be flat, 0.00. The month of May, that was actually up 0.1%. And then retail sales ex-auto expected to be up 10 basis points, 0.1%. And the month of May was actually down 0.1%. So that will be the key metric. We've also got on Wednesday 2 housing data points that hit. We have building permits, housing starts. Building permits expected to be down a little bit from the month of May, and housing starts a little bit better than we saw in the month of May, nothing big. And then the last one, this probably won't move the markets, but initial jobless claims will be coming in, and the expectation is this is an elevated level from what we saw just 2 months ago, but about 235,000 jobs. So one last thing about this week in terms of earnings news, or I should say news, but economic. But in terms of earnings, S&P 500, another big week. Last week was modest. It'll pick up this week. Financials, later on in the week, we'll see some tech names. We'll see some healthcare. So some of the big names reporting this week, we have BlackRock, we have Goldman Sachs, Bank of America, Morgan Stanley, American Express. Then healthcare starts. We have J&J, Abbott. We have Netflix, Taiwan Semi near the end of the week. So those will be the key items in addition to the retail numbers for this week that'll really drive market returns for the rest of the week. So that's it for the economic recap this week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.